TREIA Millennial subgroup meeting. Just like we said with TREIA Fayetteville the other night, one of the good things about lockdown is we're all millennials and we're all Fayettevillians. We all can come to all the meetings. Of course, that offsets the bad, which is we can't shake hands and hug and meet your forever financial friend in a meeting. So we are doing our best to make up for that. One of the ways is what you just saw is a vendor spotlight, so you can get to know our vendors, as well as member spotlight. So we encourage any of you who would like to send us an email at treiaprojects@gmail.com. And you're all welcome to make a little member spotlight video. Just say hello, get to know your fellow members, and let people know what you're looking for. If you're looking for a partner or a lender or whatever, just say hello, get known, take advantage and make the most of your TREIA membership. That's one of the ways we're compensating. Another way is with our TREIA Facebook networking page. That is Triangle Real Estate Investors Association networking group on Facebook. There's a lot of action going on in there as far as networking, so check it out. Another way to introduce yourself, you just say hi, get known, post deals, what you're looking for, what you got, look what other people have. These are the things we're trying to do to make the most of our lockdown. We are also looking for your suggestions, so send us an email again, and any ideas you have. We're all in this together. We're looking to make this better for you. We worked a long time, 3 years, to get this new structure in place so that we can offer some of these new things. So we invite you to take advantage of them. Let us know what classes, what instructors you'd like to see, what kind of projects. We are actively looking for all your input. So tonight we have a very exciting speaker for you, Adam Schneider. I know many of you are really have been wanting to hear him talk. We've talked about this in other subgroups. We're looking forward to him. A couple upcoming things. We have our new series, Real Estate 360. This is another lockdown initiative. It's the last Tuesday of every month. And what we're trying to do there is bring you some unusual things that are a little more riskier, like that we wouldn't maybe bring those live speakers in to have a meeting because we don't really know what to expect. It's things that are different aspects of real estate that you might not have considered before, just to give you a more rounded picture of what might be available out there. The first speaker we had was extremely successful, Marco Kozlowski, and he spoke on how we can buy hotel properties for no money down and even take money out. It was so great. I never signed up for anything, and I haven't signed up for it, so I'll let y'all know how that goes after September. Our second one will be the last Tuesday in July, and that's going to be on tax lien investing, which is something you can do in any state, multiple states, from the comfort of your PJs in bed. So we look forward to that. And we have other board members on tonight. Chuck's not here, is he, tonight?
No, he's not on.
We have Leslie Ortiz and Jackie Richards. Any announcements y'all have?
I think no, just the main meeting coming up next week. Get registered early, and just keep checking your calendar. We're posting new things all the time, so.
And that main meeting is going to be on subject 2, which is always a super popular topic. So yeah, you do want to get registered for that one. Mm-hmm. So again, this is TREIA Millennials. I mean, you know, we had talked about this as a board, but it doesn't even really matter what our subgroup names are. But you know what? We're keeping them just because we'll need them when we get back to normal. But for now, man, come to all of them. You don't have to be east, west, north, south, women. Experience is probably a little different. You know, you're not really going to be interested in that if you're not experienced, and possibly new. Might be boring for experienced investors, but otherwise, man, be Fayetteville, be a millennial, come to them all, make the most of it. One thing that we have decided, this subgroup has struggled for a long time to find a home. It never could find a good place to meet. No one was ever happy with it. So we decided this works so well, even after lockdown, since it's millennials, we're gonna keep it virtual. Mm-hmm. So y'all can always come to it. Welcome, and that's enough. I think we're gonna let Adam get started. Adam, as you probably all know, is with Oakwood Lending. He is one of the favorite lenders in TREIA, and he's going to tell you what it's like to do business now and what you need to do if you want to do business with him. Go ahead, awesome. Adam, take her away. Oh, sorry, one more thing. If y'all have questions for Adam, he always like to take them as he goes along, so feel free to put them in the chat, and we'll read them for you. Go ahead, Adam. It's all you.
Awesome. Can people see the screen?
Absolutely. Yes, we can.
Okay. So we're here to educate and we're here to entertain. So just as she said, I'm with Oakwood Lending and this is on hard money lending and it's for our millennial subgroup. So to start off with our clever entertainment here, I love this one. So when you can get on TV, but the only thing they say about you is that you're a millennial. Can you guys hear me? Are we, is everyone muted?
Yeah, it's good.
Okay.
Yeah,
So
we can
That's
My,
your claim to fame, huh?
yeah, my daughters who are teenagers, they would say that it was probably a boomer who came up with this one. Anyway.
I hate it when my kids call me boomer.
So the next time someone complains about millennials, and since we're in real estate, maybe remind them which generation linoleum all over all of those beautiful hardwood floors. So if you don't know, millennials are Gen Y. That means you're from 81 to 96. And so if you join this meeting, but you're not in that range, TREIA is going to charge you double. So you'll still be paying zero. So I'll be here all night with these jokes, but you guys want to talk lending, so let's do it. So I'm going to cover a little bit of my background, talk about why we're here, talk about lending at a base model for real estate in terms of residential versus our investor stuff. We've got a lot of people who love the BRRRR strategy. We have wholesalers, people who want to be private lenders or are. So I'm going to cover all of that stuff. The PowerPoint presentation is just going to be designed to keep us on track. We got about 24 of these, and we can go as fast or as slow as you want. So I got all the time in the world. So I was in the corporate environment, and then in 2012, right after the hangover from '09 with real estate, I joined Home Investors, the We Buy Ugly Houses people. I became a real estate agent. And in August of 2012, I joined TREIA, and that was an absolutely fantastic decision. It's invaluable, both in terms of the education you get and the people you meet. 2014, I became a development agent, helped to recruit and coach other people to be in the business. 2015, I started lending. 2017, I started hosting the Experienced Investor Group for TREIA. 2018, I did the first raise with a 506, a Reg D. So at this point, I've done about 150 flips and 2-3 times that many in terms of loans. So I think I'm somewhat of a subject matter expert. Love talking about it and love helping people. So tonight, we're here to educate everybody on how you can work with lenders, whether they're private or specifically private or institutional, no matter what your niche is that you want to do. It's free, take advantage of it. And if we don't get to cover all your questions during the meeting, you can always catch me later, just send me an email. All right, so lending, how does it work in general? If you don't self-fund everything, you're gonna have to either look for a bank, a friend and family, institutional hard money lender, or a private lender. So why doesn't everybody use the banks? Because these things are the least expensive with the most money, the longest terms. They're excellent for the rental inventory, but we don't see them in the space of flipping homes and wholesaling. And if you're new, here's the reasons why. Oftentimes there's a qualification issue. The borrower or the property doesn't qualify, or the borrower doesn't like the fact that the bank wants 20% down. Banks are slow, they want appraisals, or the seller or the wholesaler won't even take a bank supported offer. So if the bank's not around, if you can get a friend and family member, that will be your second least expensive option for your lending business or for your borrowing business from a lender. If that you got that and it's solid, go for it. The risk factor is the low reliability, especially as the price points go up. And so if the banks are out and the friends and family are out, you're looking for a niche of hard money lenders. So it's called a hard money loan because the loan is primarily based on the hard asset, which in our business is the real estate. So the institutional players, the ones who are around all over the country, those people have unlimited funds. They're lending everywhere. They're expensive. They're usually 6 to 12 months. They're focusing on the collateral and your real estate experience, and that will impact your rates, your skin in the game, and the terms. Then you're going to have your private lenders, and these are private professional hard money lenders. Oakwood Lending is an example, but we have plenty of TREIA members who are also in this space. They're going to be expensive short-term loans like the hard money ones. There'll be a little bit more flexibility with what happens. And all of these are only going to loan to entities in first position. They'll have a geography restraint. We stay in North Carolina, and they'll usually be hovering around 65, 70% LTV. So as an example, this isn't selling Oakwood, but it's just how it's going to work. And this is going to be similar for most people in some formal or informal setting. You'll need to apply, and then you're going to need to provide certain information. So if you've never done this before, you'll need to know your comps, your photos, scope of work. They'll want to know who you are, so bring an ID. People are going to want to talk about your exit. And then there's the soft skills, which includes your professionalism and your experience in real estate and in business. We have a lot of people who are new to this. And so the newer you are, the stronger you're going to need to come across with your professionalism, with your details, and with your other business experience. So I want to start with the comps and the ARV. So if you're going to go and submit a loan to anybody, they're going to want to know, where did you get your darn comps? So you either did a BPO, and if you're unfamiliar with that term, it's a broker price opinion. So a listing agent or a real estate agent would have told you what they think it's worth. Or you'll have an appraisal, or you'll have a Zillow one. And if you're going with Zillow, everyone's ears are going to be up pretty high. So that would be the least enviable one to use. The appraisal's the strongest one, but you may not have the time or want to pay the money for it. And so whatever you do, just be ready to substantiate what you have. The risk with the BPO is that the agent giving the BPO has an incentive to fluff up the numbers a little bit. So your lender is going to be doing their own checkup behind it. So if your numbers are the same as the lenders, then they're going to check this off the box. They're going to be comfortable and keep on moving forward. But if it's not, that's going to be a long conversation. So that's a critical first piece if you're asking for a loan. Kathy, if we have questions as we go, just let me know, okay?
I sure will.
Okay. So then there's the exit strategy. And so your lender's going to ask you this for a lot of reasons. If you've got a high-priced property, $400,000 or $500,000 property, you probably only have one exit, and that's a flip. So you really need to make sure your numbers are playing. If you've got an entry-level positioned home, $150,000, $200,000 price point home maybe, you may have a secondary strategy. So if your flip doesn't work, you can probably convert that into a rental in most parts of our market, refinance, cover your note, and there's a safety valve. If your exit strategy from the very beginning is that you want to execute the BRRRR method, then we're going to have a long talk about that, and I'll get there in a second. And so for these reasons, the lender's going to help you through it because they want to hold your hand if you're newer and make sure that you're not putting yourself in a bad position. And then they'll want to ask if you've got reserve funds. So if you're coming into this with $0 in your bank, no matter what the gurus say, it's a concern for the lenders.
We got a question, Adam. Does Oakwood Lending require credit checks, income verification, etc.?
Right. So we don't do an income verification. We do want to know if you have cash available for the reserves. We want to know if you've had a foreclosure or if you've had some kind of a really negative piece on your credit rating, like a bankruptcy. But if you just have a low credit score, but the deal is strong and you're strong, we want to run with that. And if that person has follow-up questions, I can sit tight for a second.
Any follow-up on that? Guess not, Adam.
Okay. So let's see here. Okay, I went backward. So let's just talk about paperwork. So if you're new to being a borrower, and if, for the people who are experienced, I'm going to apologize because some of this is basic, but if you're new, it's important. And we have other things where we're going to get more sophisticated and the newer people might feel a little bit overwhelmed. So we'll bounce back and forth. There's 4 real pieces of paper to understand that the lender's going to want. There's going to be a promissory note, which the lender will draft. And that's your agreement between your borrower and your lender. It's got all your terms and conditions, if there's prepayment penalties and all that stuff. And you'll want to read that so that you know what you're agreeing to. And it's surprising, but a lot of people don't read it, and then they get frustrated later on. Then there's a deed of trust, which is the security instrument for you, the lender. So if you're getting into the lending business, Make sure you get a deed of trust. This is the mortgage, as you'd be familiar with if you're just buying your residence. And almost always you're going to find that the hard money institutional lenders will require a first position lien position. And almost all private lenders will do a first position. If it's a second lien position, it's going to be really different. We don't want to get into that today. Then the lender's going to want the borrower or require that the borrower generate insurance. So you'll list the lender as a mortgagee, not as the additional insured. And quite often it's the day of the closing and the borrower is ready to go and they forgot about insurance and the lender's just sitting there because the lender's not going to let the funds be released to the closing attorney until there's insurance. And then lo and behold, you can't close on the Friday, you close on the Monday because of that. So just make sure you check off that you get the insurance done. On the title insurance, the way that works is the closing attorney is going to handle it for you. The borrower will pay for title insurance for the borrower and for the lender. And that's all paperwork done by them. So those are the pieces of paper.
Mike, sorry. Mike Ollison asked, based on your experience, who are the best insurance companies to deal with for rehabs?
So if you've got a short-term one, you may want to go to a national player like NREIG, National Real Estate Insurance Group. They'll lend vacant properties, but you want to reach out also to the tried and true, the State Farm, Nationwide, Erie, Farm Bureau, and talk to your agent about what's going on there, especially if it's going to be a rental, so they all change. So I use the one lender for the flips, and if I'm going to stabilize the property and keep it as a rental, then I migrate over to one of the bigger players for the longer term loans. So NREIG will let you quote how much you want to have it insured for. And the State Farms and Nationwides, they may require that it be done for the replacement value.
Deval asks, do you do loans for construction?
So on a construction loan as a new build, is that what the question is?
That's what the question is, yes.
Yeah. So we don't do as much in the new build space, but when we're in the new build space, the way we play it is this. We want the borrower to pay for the land, and then we'll do the construction on a reimbursement draw basis, just like a rehab on it. And that's how we play that.
And finally, one more question. Gregory Page asks, you mentioned 65 to 75% loan to value. What would be the reason to go as low as 65? And do you bundle the cost for rehab? I'm not exactly sure what that means. Maybe you are.
Yep, got it. So the different ratios of loan to value are going to be determined by a bunch of different things. So I'll give you an example. On a $1 million home, the difference between a 65 and a 70% loan to value, that's a $50,000 shift for the borrower. That's a lot different than a $50,000 home. So we look at that. We look at the risk factor in terms of days on market, reliability of the comps, experience of the investor, of the borrower. And I'll give a good example. You could have two loans that are $100,000 that look different. Let's say one of them was $80,000 acquisition and $20,000 rehab, and the other was $20,000 acquisition and $80,000 rehab. Well, they're both $100,000 loans, but from a risk factor, the one that's $80,000 acquisition with just a $20,000 rehab is way less risk. So that one, the lender might be willing to go to a higher loan to value, where on that other example, it would be a much lower loan to value.
Okay, we actually had two more questions come in.
Hang on, but I got to do the bundling.
Oh, okay.
So the bundling. So what we'll do is, and I'll use a round number example for this. Let's say the ARV is 100,000 and the repairs are 20. What we would do is we would, at a 70% loan to value, we would lend 50 for the acquisition as a max. That's 78% of 100,000 minus the 20. That puts you at 50. So we do that at the acquisition. And then on the 20,000 rehab, we would do that on a reimbursement draw. So maybe you do 10,000 out of your pocket, then we'd reimburse you, then you do the next 10 on it. So that's how we would handle that. And I think most lenders would handle it in somewhat of a similar fashion.
Anthony Rivera asked, does the value of the land matter in regard to a construction loan?
Yes.
This is a question from Patrick McDonough, but before I read the question, do you lend on buy and hold deals?
So we only do the bridge loan on the buy and hold part, Kathy.
Okay. I'll ask the question. I'm not sure if it's relevant or not. Let's say it's a $50,000 purchase. This is from Patrick McDonough. Buy and hold. Rents for $600 a month or better. 30% down is $15,000. How much in reserves would Oakwood want to see on a deal like this, or a general percentage / number of months of rent on any size deal?
So we look at it this way, and I don't know if I'm going to speak for all lenders on it, but the way we look at it is, if we have to take the property back, can we get out of it if we don't want to be the renter or the landlord on it? So we're going to look at the ARV on this one, and that's going to be our main focus, not on the cash flow. But when you do the BRRRR method and you're going to refi us and kick us out, which you should do quickly, and you're going to go the bank loan, then those guys are going to be concerned about your debt ratio numbers.
Okay, so that's all the questions. And Adam, this is not a question, but just for our less experienced investors, maybe you could just quickly explain what a bridge loan is.
Yeah, thank you. And Kathy, if there's anything that I say that you want to add to from a legal standpoint, don't be shy.
Thank you, but nothing so far. You're doing great.
Have I missed anything so far that you think needed more coverage?
You're hitting on it all.
Okay. So bridge loan would essentially means it's a short-term loan. You don't really want to be in that one for a long time. It's a bridge between two things that are happening. So if you're buying and we'll get to it more in the BRRRR strategy, but a transactional funded loan is a same day loan. And then that's a little bit different. Then there's a bridge, which is just short-term. So we're just giving the money so someone can buy the property and do whatever they want quickly. And if they want to keep it for the long-term hold, that's fine. Kick us out as quick as you can and get into that bank loan. You okay?
Yep, that's all we got for now.
Okay. So if you've done an application with a bank before, the application process can take a long time. You send them paperwork, they ask you for more, they want clarification, and it's like just peeling the Band-Aid off very slowly. That's not what's going to happen with the hard money lenders. The institutional lenders really vary on this, and some of them are really quick, and some are moderately quick, and then the private lenders are going to go fast. So if you're expecting the loan process to be slow, and all of a sudden they're asking you for stuff and they're ready and you're not, that's problematic. So you do want to have all your paperwork ready, and the lender may say, yeah, this all looks good. Who's your attorney? You want your attorney lined up. And it's either going to be a situation where the lender is going to go to the site with you and do a site visit, or based on the deal and based on the relationship, it may be something that's just done virtually, and it just some photos and videos and such will do it. And so it can be a 24-hour spin on that. So I just want to make that point clear. So be ready if you're going to be the borrower to have all your ducks in a row when you present the loan request. Okay, so let's just talk about the different groups of people who might work with lenders. And I'm going to start with the wholesalers because this surprises people. So a lot of people think, I'm a wholesaler, I'm going to put it under contract, and I'm going to go ahead and assign this contract. I'm never going to take title. That is not always the best decision. You may have a scenario as the wholesaler where the property is tenant occupied, the tenant makes it really difficult for you to access it, to show it to any end buyers, and you can't make any money. But you knew if you had title and you got the tenant out, you could really do well. So private lenders, and we're in this boat, are willing, ready, and able to lend you the wholesaler money as long as the numbers work. So you can take title, clean it out, put it on MLS, and make way more money. So you'll just do your math and feel comfortable that you can, the increase in the revenue by taking title and marketing it on MLS will cover your debt service and your closing costs and your selling fees. But we work with quite a few wholesalers on that kind of a transaction. Then there's a same day double close or transactional funding. And this is a scenario where you're the wholesaler and the assignment fee is so big that you think that at the closing table, If the seller sees what the assignment fee is, they may explode, be really upset about it, and then it may blow up the deal. Pigs get fat, hogs get slaughtered. It may make more sense for you to do 2 transactions, one where you're buying it at 9 o'clock and then you're selling it at 11 o'clock, where you have some transactional fees and attorney fees and such, and you're going to pay debt service for the day with the lender. But with whatever money you've spent, you've saved yourself the risk of missing the entire deal. And so we encourage people to think about these options as a wholesaler. And then the third one is this. Let's say you're a wholesaler and you've put a property under contract. Go to your favorite private lender or lenders and ask them to come on over to take a look at it and essentially pre-qualify the deal. And if that lender agrees with you on your numbers, with your rehab and your valuations and such, then when you, the wholesaler, are marketing that property to your list, you can tell them that you've already found a lender who's willing to lend you the money as long as you, the borrower, qualifies. That will significantly increase your pool of buyers, and it will significantly speed up the process.
Got 2 questions that came in. Mike Ollison asks, how long is a take title loan for wholesalers?
Well, that's a good question. So our standard loan is 6 months with a couple of extension options. And we only charge for the time that you use the loan, Mike, as long as you pay at least $1,200. So as an example, if it was a $100,000 loan and points were 2, that's $2,000, and the interest is 12%, that's $1,000 a month. So you've already covered the base $1,200. So if you needed the loan for for a month or 2 months or 3 months, we're totally fine with it.
And Pamela Fox asks, what's the average time to close on these loans? With some properties, we must move quickly.
Yep. So if the borrower has got their paperwork lined up, on our end, we never slow it down. It's always the attorney doing their title search. So on average, we are closing the fast ones in 2 or 3 days. Our super fast crazy story was we had a repeat client of ours at 1:30 call us and tell us that he needed to get a same-day double close loan done that day. Otherwise, he was going to lose this gigantic deal, and we got the money in the attorney's office by 4 o'clock. So super scramble, crazy story, outlier. Normally it's measured, time is measured just in terms of a few days.
Oh, that's pretty awesome.
It was crazy. It only happened because it was a repeat client and we knew the attorney. Oh, and that's another thing I'll say. And so for those of you who don't know, Kathy's an attorney and she's very comfortable in this space. But if you're working with an attorney who's comfortable in the space and you're working with people who you know, people will hustle and get it done. But if you're working with an attorney who's not comfortable with a double close or with assignments, it's problematic and it's going to slow everything down.
And you should figure that out up front before you ever even get to Adam.
Right. If you're going to be doing a same-day double close, that actually reminds me of something, is you need to have the same attorney doing both sides of the transaction.
Absolutely.
Kathy, stay with me. Am I missing anything on these concepts?
No, you've got it all, Adam.
Okay. Keep on rolling or slow down?
You're great. Perfect.
All right. So wholesalers, food for thought. Certainly glad to answer other questions. Now, what about the flippers? So this is sort of obvious, but one thing I want to talk about is there'll be some lenders who are only going to loan on the acquisition portion or a portion of it. Some are going to do the repairs and some will do both. And so when you're talking with a potential lender, you'll just want to know what they do. And if you're a lender getting in the business, you'll want to market yourself and let the borrowers know what you're going to do.
Well, here's a quick one that just snuck in, Adam. Sorry. Al Kirk asked, do you lend only on single family residential or multifamily as well?
We do single family, we do duplexes, we do manufactured homes that are affixed to the land, we do townhomes, and we do condominiums.
Thanks for your question, Al. For those of you who were with us at the beginning, we saw Al in his member spotlight there.
Got it. And so a manufactured home is a really important topic because some of these things are actually personal property, just like you'd buy and sell a boat or you'd buy and sell a car. and some of them are affixed to the land and they're considered real property. And if you're doing a refi loan with a bank on a manufactured home, they won't lend for as long of a period of time as they will on a site-built home. So if you're a flipper and you're working with a lender, know that you'll want to have a discussion about how the reimbursements work and how quickly they happen, and if there's draw fees and stuff like that. So we don't charge for draw fees, but certainly a lot of lenders do charge because there's a cost involved in checking out the work. Okay, BRRRR. So what is BRRRR? So that's this great strategy that became popular 3-4 years ago. Brandon Turner with Bigger Pockets labeled it this way. So you're buying the property, your discount property, then you rehab it, then you rent it out, then you refinance it, and then you repeat. That's your BRRRR. And it sounds awesome. You don't have to put a lot of money out. Bada bing, bada boom. But there's a bunch of things to think about. So first of all, you need to wear a bunch of different hats to execute. You've got to be an acquisition specialist, then understand how to do your rehab, then deal with placing the renter, then going to the bank, and so on. And while it sounds easy, we've experienced a lot of things as a bridge lender here. So we will do the loan for the part where you're buying this property, you're buying it quickly, you're striking there. Our money's expensive, but it's fine because it's a short-term thing and you want to get us out of there. But here's some things that can go wrong. You haven't talked to the refinance lender and you don't understand what's going on. So the first thing is you need to know the term seasoning. That property needs to season if you want the most money out. So if you go and you buy this property and in a month you fixed it up and you got your tenant in place and you go to get the refi done, the bank is not going to lend you the money off the appraised value because it hasn't seasoned. The bank is going to lend you the money as a percentage of your purchase price or your purchase price plus your rehab. So you're going to have cash out of pocket. So what you'll need to do if you want to get more money out is you're going to need this to season. And they may tell you it needs to season for 6 months or 9 months. If they say it needs to season for 6 months, that doesn't mean you get your money in 6 from the bank. It means at 6 months, you're eligible to submit your loan request to the bank, which means it may be 8 months before you've actually all in, before you've gotten your refinance there. So you let it season 6 months, they appraise it, it appraises for a strong number, then they'll finance off of the appraised value and you can get your money back. So you need to understand that and talk through that with your refi lender. The second is the top, yeah.
Oh, I'm sorry, it's Jackie. Just, do you have any recommendations for traditional banks that'll do 6 months over 12?
Mainly it's community banks, or it'll be a credit union that might be more favorable on that, but there might be other people on this call who are better to answer that question. And if there's somebody who wants to chime in, I'm certainly glad to let them do that.
Actually, someone did. Gregory Page says, yes, I just had this same conversation with BB&T today.
And what did BB&T say?
What'd they say?
The exact words.
What'd they say?
He said the exact words that you said. I don't know. What exactly was that, Greg?
Months at 12.
6 to 12 months.
Yeah, Jackie, I think some of the answer, so if people are unfamiliar with the term overlay, overlay is an important one too. So here's how I describe overlay. So in North Carolina, if you want to buy a packet of cigarettes, you got to be 18 years old. But Walgreens said, we want to go stronger. So at Walgreens, you have to be 21 to go buy your cigarettes. So Walgreens has an overlay that's above and beyond the minimum federal state standard. Banks are the same way. There'll be federal requirements, but then the banks can have their own overlays of additional requirements they want that may be based on any number of factors, including your relationship with them. So it's a circular answer, but it's one that if you keep asking the banks, they keep having different answers to it. So Jackie, it's a really good one. The key is to talk to the potential lenders right ahead of time on that. Then there's the property requirement. If it's a manufactured home, it's a different story than a site built. So you'll want to make sure you're clear with the lender. There may be a scenario where you did one loan with a bank in one town and it was great. And then you've got another one in another town and they aren't doing any loans there. So anytime you have one of these things where the rug's pulled out from under you, the issue is these short-term loans are really expensive. And so you're carrying short-term loan expensive money. And maybe you could have carried it for a shorter time if you'd done more homework. And then there's a minimum loan amount part. So on the one hand, we all like buying these really low priced homes, but the bank may not refinance it if it's under 75,000 as an example on that. So you'll want to ask all these questions if you're doing the BRRRR so that you understand what's happening on the refi part, because that's the critical piece that usually is the rug being pulled out from under you. So you can get out of the bridge loan, which is what we're doing as the private lender in the beginning. I'm just giving you time here in case people have more questions on this one, because I usually get a lot.
One just came in. BRRR, what about BRSR, buy, rehab, sell, repeat? Is this seen as less, is this seen as just as favorable as BRRR?
Well, if you do buy, rehab, sell, repeat, then you don't have to deal with the bank. So you're just doing flips. So that's a totally different model, and it's way simpler. It's just got a different exit goal. The BRRRR method is for people who want to build their portfolio of inventory for passive income.
We good?
Good, okay. So what do lenders look for when there's a loan? So the first thing is you need to be an entity. So all these hard money lenders and private money lenders, these are business to business loans. It's different than a business to consumer loan. These are for business purposes. If you're going business to consumer, you have to be an RMLO. If you don't know what that is, you can look it up. It's a licensed mortgage loan originator. And we don't want to be that. We haven't gotten a license for it. We don't want to deal with TREIA and all this stuff. The second you become an LLC or an S Corp, whatever you want to be, then you're an entity. If it's for business purpose, then we can rock and roll. So if you're planning on doing this, get that done early. Then there's the track record. So people are going to ask you about other business and deals you've done. So anything you can do to show your track record, that helps. Then your experience. So you may be in real estate, but not have done rehabs. So what can you bring to the table? The professionalism and communication is important. When people communicate early when there's a problem, it's so much more helpful because the lender can help you through it. And we've got really, I think, in our market, a lot of really good private lenders who really do have the borrower's interest in mind as well as their own. And if you give them early advance warning, they've done some incredible things where they've gone above and beyond the scope of duty to help. But if they don't get it until the end, then you're really in trouble. We talked about the importance of the accuracy of the ARV and the comps. Let's talk about the scope of work. If you say I'm doing a rehab and it's 30,000, and someone says, well, how'd you get that? And you got it from the wholesaler told it to you, that's a problem. So we're going to want to go into the details of it, and we want to go to the line items. And your lender may have some deep questions for you about why you're doing things a certain way. It's for both the lender's benefit and for your benefit. So the more detail you can share, the better that experienced lender can help you. Lenders are going to ask for skin in the game, cash reserves, the exit strategy, and the size of the project. For us, because we always think about it in terms of whether we would, if we had to take over the project, can we do it? We're really comfortable. I'm comfortable taking over that $30,000 or $40,000 project. But if your project's $100,000 rehab, that's a really big one, and we're going to have a different conversation about that. So just think about all this from the lender perspective. Okay, so some people on the call might be people who are thinking, I'm thinking about being a private lender myself. What do I do to mitigate my risk on it? So these are the things you're going to want to look to do. You're going to want to decide what their maximum loan to value is. And these things are redundant, but I want to stick with them. You'll want to think about how important the borrower is. Make sure you get that deed of trust. And then if you've got the title insurance and the insurance and you got your promissory note, you're in a pretty good position as long as all these are straight numbers on it. And this is really helpful, I think, if you're just getting started, to understand that these are certain minimum things that you'll want to have in your arsenal. So pro tip for borrowers, the first thing is, if you just put yourself in the shoes of the lender, as with everything, then you'll understand, how you're going to want to act and operate. And the more info you can provide, the more likely the loan will be approved. In a lot of cases, you'll be asking to do a loan in a territory where that lender may not be that familiar with it. Even if it's someone doing just North Carolina, obviously we have 100 counties, and there's nobody who's going to know everything about every county. And so the more detail you can provide to make the people feel comfortable, the better your chances are to get the loan approved. So some summary pro tips. Again, really think through the exit strategy, and if you've got more than one, that helps. Things are going to go wrong, and when they go wrong, be in front of it and proactive and share and communicate with the lender on it. Get them to the party early, especially if you're that wholesaler. And if you've got a property or a deal and you've presented it to a few different lenders and everybody's told you, no, they don't want to do the deal, you may want to just take a step back and think about if you want to do the deal.
Got some questions rolling in now, Adam. The two are kind of the same, so I'm going to read them together. Pamela Fox asks, is there anything we can do to get in a position with Oakwood before we find the property? For example, complete a form that details your experience, reserves, plans, etc. And Melanie Nickdell asked, do you have a preferred format for the packet of information we present when requesting the loan?
I love those questions. So I'm always glad to get on the phone with any TREIA member. The main things that we are going to ask for before the deal are the credit issue, if you've had any major credit problem, and what your experience, well, three things, what your experience is and what kind of deal you're looking to do. And usually that migrates into whether people are looking to do new builds or the BRRRR method, and then we go longer. If it's just a simple flip and the credit doesn't have anything crazy and the deal's good, we're good on that. Oakwood Lending, there is a client application part of the site. You can certainly fill that out. And then when you submit a loan request, once you do that, it'll spit back and ask you for the backup information. And we're comfortable taking whatever form is good for you, the borrower. But that's a really good question.
Okay, Mike Ollison asks, what areas of North Carolina do you lend in?
So we will take everything in the triangle. We are heavy lenders in Fayetteville. We seem to have been doing a lot in Wilmington and certain parts near the coast. We'll cover stuff in the Triad and Charlotte. If you're going to go and take us to some really rural small town that I've never heard of, and I need to Google it and figure out that the population's 8,000 people, we're going to press harder on those kinds of deals.
From Mike, oh wait, I already asked that. From Amin Deval, who are good lenders for new construction, single family homes, or rental? And do you know of anyone doing non-recourse loans for new construction?
I don't know. And a lot of those questions have changed, Kathy, since COVID jumped in. All these lenders have changed their stuff, and you really need a pencil and a scorecard because they're changing and going back and forth quite a bit. There are some national lending organizations like the American Association of Private Lenders, AAPL. I'm a member of that. National Private Lenders. So you may want to reach out to a large lending organization like that and ask them. I think that there's maybe 16 or 17 main institutional hard money lenders as an example right now. And a couple of them, I think, have gotten back into providing rental loans. I know there's a few people whose names I recognize on the call who might have more info on that, but I'm not familiar with who's doing it.
If anyone has any info, feel free to tell us in chat. I will tell you that I had a portfolio loan lined up for 6 of my rental properties. I had done it just because one of the commercial loans that covered 2 of them was coming due. So I decided, rates were good. I was going to do a portfolio refinance, and it was approved and everything. And then COVID hit, and they just said, we're not doing rental loans anymore. That was Lima 1. But I will tell you that recently, I don't know for Lima 1, I felt like when it changed, I would just go with them since they had all my stuff. But lately, I've gotten offers from several lenders who say they are doing rental loans again. So I've restarted my process with someone else. I wish I remember the name, but I don't. I'll try to find it before this call.
I know.
Go ahead, Jackie.
I know Lending Home has started doing the rental loans again, but they have increased their APR because
CoreVest. Mine was CoreVest. I think that was CoreVest. And I don't have their rates or anything yet. Adam, someone is Mike Ellison is asking about your rates, but I think you already said 12%. I don't know if there's anything else.
I was so I was hesitant to mention our rates, Kathy, just because I wanted to be sensitive to the fact that this is education instead of selling. But he's asked it. So we're 12% interest and 2 points for the majority of our stuff. We charge points at the front. We charge interest at the back for many of the loans. Some loans are a little bit different, but that's our standard. We don't require an appraisal. We don't charge a loan application fee, and we don't charge draw fees. We're 6 months and then some extensions, and they're more expensive. And I think that that's somewhat in the ballpark for most of the people in our market right now. The terms might be a little bit different one way or the other, but I think that that's a general number, and you can certainly, other people on the call can tell me if they think that that's a correct statement or not.
I think it is. I wanted to just jump in because Adam, you had said something in an earlier slide about communication and professionalism. And just to all of the TREIA members, and especially if you're new, and once we start our in-person meetings again, you should remember that if you're a private money lender, like I lend, I don't lend at the degree that Adam lends, but people are always watching the way you present and the way that you talk. And so just have an awareness. I had a situation probably 8 months ago where somebody was telling me how everything was going wrong in their business and bless their heart. But then at the very end of it, they said, oh, would you lend me some money? Would you be open? And I thought, oh, you just spent 20 minutes telling me everything that went wrong. So just have that awareness. That
That's funny.
people, people are always looking, and it's not always based on experience, but it's the way you present yourself. It's are you somebody that can work through a challenge when a challenge occurs? Anyway, my 2 cents.
Yeah, I think I
think Jackie's right. And also just being, a TREIA member says something about you, that you are, willing to invest in yourself and your future. And one of the things that you can do to increase those sort of things that Jackie and Adam are talking about is come to every dang meeting that you can, because, we put on some really good education. It's all included with your membership, so take advantage. You will learn so much, and part of what you learn will help you in all these things, because we have people who present on how to do your numbers, how to find properties. So if you come to enough, you'll get the complete picture. Adam, Richard Marcato, do you have a general minimum of cash reserves that you like to see?
Hey, Rich, how you doing? We've done business together, so I wanted to say hi. Rich, so it really is going to depend on what we think the risk factor is on the deal. So if it's a small rehab and we can zip in and out, we don't need that much of a cash reserve thing. If you've got something where you wanted us to do 3 properties at a time and the rehabs are bigger, then we're going to ask for a bigger reserve. So that's a deal by deal discussion with who we're dealing with there.
That's all I got, Adam.
Well, I really appreciate, guys, the opportunity to talk about it. I love talking about this stuff, and I really appreciate the people who asked the questions there. And I don't want to belabor it. I'll stay on it if people have any other questions for a few minutes here.
I think put your last slide up, Adam, so I think you have contact info. I'm sure people are going to want that.
Yep. Sorry. Thank you.
I'm not getting any more questions, but I'm just getting people saying excellent information. Thank you. Thank you. Great presentation. Thank you.
I'm glad to be able to help.
But if y'all have any more questions, feel free to ask them. Last chance here. While you're thinking, board members or any other announcements or anything we missed, any member have an announcement? Tim Johnson says great info. Christopher Foya says thank you. Pamela Fosk says excellent information. Thank you. If anyone has any announcement they need to make, you can go ahead and do that quickly. Jackie, Leslie, or any member. Otherwise, we'll give you a couple seconds here to get any last minute questions, and make sure to take down Adam's information.
Mm-hmm.
Loretta Bell says, thanks, Adam. Ron Rice says, nice job, Adam.
Hey, Ron.
Well, we can just sit here and read congratulatory
Congrats,
remarks.
congrats.
All right, everyone. I guess that's a wrap then. Thank you.
Good meeting.
That was a fantastic presentation. You guys, this has been recorded. It will be on our website within 1 to 2 days, being however fast I managed to get it up there. The way to access it, if you want to look at this information again, is to go to the calendar, click on this meeting, click on July 16th, and you scroll down, and towards the bottom, there's just click play, and you can watch it all again and do it all.
Can you repeat that, Kathy, one more time so people can find it?
Yep, absolutely. But hold on, there's a question that came in the meantime. This isn't lending related, but do you know any title and escrow companies in the Triangle area who are familiar with wholesaling? Oh, honey, we'll talk. Yes, we do, Christopher. I'll send you a private message. How long do these meetings stay on the calendar? Pamela, as far as I know, they stay there forever.
Ever. But, you just got to click months going back if you want previous, but.
Yeah, so they don't go back very far because, of course, they only started with COVID because they only started with Zoom meetings. But as long as, and we have liked it so good, we have been talking about once we start live meetings again to record them so we can put them up on the website. We normally can't do that with the big national speakers because they don't let us. Yeah. But once again, the way you find that is to log on to TREIA.com, go to the calendar, click on calendar of events, go to July 16th where you will see the Millennials meeting, click on it, scroll down.
After today, it'll be crossed out, but if you click on it, it'll bring it up.
Yeah, that's a good point. It is a little confusing because it's like, it's like it's light and it's crossed out, but it's still clickable. So yeah, don't worry about that.
Still click on it.
Scroll down towards the bottom and you'll see a little arrow to just start the video. And I've been trying to get them up quickly. I'm gonna try to do it tonight, so it should be up soon, but I always say 1 to 2 days just to buy myself some time in case I don't get to it. Marty Reardon says, enjoyed the meeting, good information. Jackie has just put that information that we just gave about the video up there in the chat so you all can see it.
Yeah, I should add that. I'll add that to some of the PR things, notes sending out because
that's a good idea. Great info, says James Clark. Okay, everyone, thank you so much for being here.
Thanks, guys.
Thanks to Adam once again. That was really awesome. What a great engagement in this meeting. So thank you, everyone. Have a great night.
Thanks.
Stay safe. Adam.
Bye.
Yep.
Bye.
The removal function is not working.
No. Ah,
There we
There
go.
we go.
we had a time delay on that one. He was stubborn.
Oh, wait, did we stop recording?
Yep.